Hi, everyone, and thank you for joining us. We're excited to welcome Gene Munster and Doug Clinton today. Gene Munster is a managing partner and co-founder at Loop Ventures. Prior to Loop, he was a managing director and senior research analyst at Piper Jaffray, where he covered technology companies including Apple, Amazon, Google, and Facebook. Doug Clinton is a founding partner at Loop Ventures and has invested in transformative tech for 15 years. Gentlemen, thanks for joining us. The floor is yours.
Appreciate that. It's an honor to be back here with the Money Show, especially with Doug. And as you heard, Doug and I have worked together a long time on tech. Loop, a little bit about Loop. We are a research-driven investment firm. And we have a private product. We have a public ETF. You're looking at the ticker right now, LOUP. That is a frontier. It's a thematic frontier tech ETF, and so it basically captures the very cutting edge of transformative tech. That's one way to invest with us, but that's not what we're here to talk about today. We're here to talk about really the future of FANG, and I think kind of a starting point with the future of FANG, it's helpful to think about a lot of these companies that are representing this next wave of growth in tech have had some pretty significant run-ups. You just look at the NASDAQ, you see the drop in 2020 in the beginning, and then it's just been up and to the right. More recently, some of these transformative names have been under more pressure than the rest of the NASDAQ. What we have seen is the interest rates, as they have moved higher quickly, the companies that have been performed the best over the past year have had the biggest reductions in their valuation. And the reason is that because interest rates are tied to hurdle rates and your discount rates when investors do their discounted cash flow, it's understandable that some of these companies that are more cutting edge have had bigger pullbacks in valuation. We do think about interest rates. We are not interest rate experts. Just to finish the thought on the topic, our expectation is that despite the Fed's dual mandate, which unlikely will be met, the dual mandate is as inflation and employment growth. That mandate, once it's met, they will raise rates. It's unlikely that that mandate will be met over the next 3 years. Despite that, we suspect that there will be some maybe temporary signs of inflation that will likely move the bond markets in a different direction. And so we are still firm believers in the power of the companies we're going to talk about today, but we'll caution investors that the yield curve is going to add some volatility to these names. We are long-term investors. We believe true investing is 3 to 5 years. And so that's the framework that we're going to be thinking about our conversation today. So if you have kind of a 1 year or less perspective, this may not be as helpful. And I want to bring in Doug here. And Doug, you've done a lot of work on bubbles. And maybe just to finish the thought, I talked a little bit about interest rates too. But what's your view? Are we in a bubble here? We've been kind of moving around more recently. How do you think about the question, are we in a bubble?
The way I think about it actually is I would reframe the question, because when people ask, are we in a bubble? What I think they usually mean is, are we in a bubble that's going to burst right now? Because you can be in a bubble for several years and enjoy great returns from that. You can arguably miss out on a lot of what the market has to offer you, waiting, preparing, thinking that we're in a bubble, and ultimately maybe do yourself a disservice by being too concerned about the bubble. So I'll answer the question, are we in a bubble right now, and is it going to burst right now? I don't think it's going to burst right now. I think the level of stimulus that the government is putting into the economy is significant. It feels like it will be very difficult to have sort of an immediate correction to the market, in my opinion. And when I say immediate, I think about the next kind of 6 to 9 months, so through the end of this year. But I think that the way we've thought about the world is valuations in tech feel fairly frothy. I think it's fair to look for tech in hidden places. That's been a big theme for us over the last 6 months, trying to find companies that may not be thought of traditionally as tech companies, but have some hidden opportunities in technology and their valuations don't yet reflect it. So my answer would be, if you're thinking about, are we in a bubble and is it going to burst right away? I don't think so, but I think people should be thinking defensively and trying to find ways to position their portfolio in the event that ultimately we do have some sort of correction.
And to take Doug's point, we talked about the 3 to 5 year window. Just simply owning these companies blindly is not, we don't believe that that is a advisable approach. And so we are much more tactical. I'll give you a quick example of a hidden tech name that we've been tactical with some of our investments with our ETF, is that at the beginning of the year, Doug, you made a prediction that Ford was going to be outperform Tesla around EVs. And I don't want to steal your thunder because you've absolutely nailed this. But why is that? Why should we think of Ford as a tech company?
Yeah, it's worked so far. Tesla's come back, obviously, but I still have confidence in that idea. The reason Ford, and I mean GM, I think you could build a similar story around. Both of them largely over the last year, separate the last 3 months from that maybe, haven't gotten very much credit for what they've been building in the EV space. We've seen pure play EV, SPACs, recent IPOs, companies in China, Tesla certainly, all benefiting from this belief, this sort of consensus belief now, that EVs are the future of the automobile. I think everybody sort of believes that. Meanwhile, Ford, GM, the traditional auto OEMs, who have arguably, I think to their credit, done a good amount of investment and innovation in the EV space. Ford, for example, has launched the Mach-E. It's had very good reviews. It's a little bit delayed right now, but I think that is a good product for Ford to kind of put them on the map in terms of a competent EV maker. They'll be launching the F-150, which is the most popular vehicle in all of the United States, as an electric truck next year. And so I just felt that Ford wasn't getting any credit for these EV products they were building, and they were really compelling products. Mm-hmm. And so I think the market has sort of started to catch up with that and give Ford a little bit of credit for their EV play here, and even their valuation, I think, still looks reasonable, of course, relative to some of these other very early stage EV companies.
The reason why I mentioned it is just to have this kind of investing fabric of being opportunistic around hidden tech, but also focused on kind of the future tech. And want to jump to the kind of the substance of our conversation here, which is finding the next FANG. And when we think about the next FANG, what FANG was over the last decade was transformative. And the ability for FANG to prove to investors that long-term holding these companies pays off, the ability that they've done that, their performance over the past decade has laid the groundwork for some enthusiasm about the next FANG. In other words, is that typically investors want to see some acceleration 1-2 years out, but because we've seen the benefits of being patient with FANG, it makes more sense now. Investors are given a little bit more leeway, being more patient in terms of letting some of these themes take hold. And I want to reiterate that these are 3 to 5 years out, but the general framework, the 5 key themes that we focus on, it would be retail and fintech. Doug talked a little bit about transportation, work, health, and play. And so we'll get going here. The first company, potential next FANG, we're not definitively saying these will be the next FANG, but these are the companies that potentially could be the next FANG. There's a company, Carvana. You may have heard some of their ads recently. Many people might have never even heard of Carvana. Doug, you want to take us through our Carvana thesis?
Carvana is, think of it as Amazon for used cars. That's the easiest way to frame it. They sell vehicles wholly online. They don't have retail locations other than some marketing vending machines that you may have seen online or maybe in your local market. And the basic idea for Carvana is, the used car market is a market that has very low customer satisfaction. I don't know very many people who enjoy the experience of going into a used car dealer, and sitting in the office and having to say no to 50 different insurance options that they're trying to sell you where they make all their money. Carvana eliminates all of that. So you buy the car online, you submit all your information online, they deliver the vehicle literally to your door. You get to test drive it in your own neighborhood, and then you can accept the car or deny the delivery if you don't feel satisfied with the test drive. And so what they're trying to do is create a really compelling customer experience for a very complex transaction, which is buying a car. Other than buying your home, it's for most people probably one of the most expensive things that they do own. Our thesis is, just like Amazon has shown that scale really proves the e-commerce model for any type of consumer good, Carvana will do something similar for the used car market, building in a complete focus on customer experience and trying to deliver the best car buying experience, I think, whether you do it with a dealer or online, of anywhere. So that's the Carvana thesis.
So when we think about the number of cars globally, there's about 90 or so million vehicles sold each year. I think the US is like 15 or 17 million new vehicles. Are there more used cars traded every year than new cars?
There are about twice as many used cars sold in the US per year as new cars. And I think that
for some reason, I remember too, it's been a long time since I've purchased I usually buy used cars, but it's been a long time since I've purchased a car, is that I always remember like the dealers make their money on the used cars, which that kind of reinforces beware when you go to buy a used car. Does Carvana have that same kind of lift? You ultimately get a car for less expensive in Carvana, and separately, do you negotiate? Is there like an online version of them waiting you out? I just have this scarring memory in 2008 when I purchased my last used car. I think I felt like I was held up at the dealer for a few hours. How does that work with Carvana?
They do a no haggle policy. So basically the price is what the price is that you see online. They're fairly competitive, I think, with used cars and dealers if you were to go to a local market. But what Carvana is really focused on is not trying to be the low price provider. That's really what I think Amazon built their model around. They're trying to be the absolute best used car buying experience, period. And so they're really focused on convenience rather than price. I think it kind of sets them, I think, apart in terms of, as a buyer. I just bought a car on Carvana actually about 3 months ago. You go into it, and the price I paid for the vehicle I bought was probably a little bit more than I would have paid if I went and negotiated with a dealer. I thought I got a pretty good deal for the used car I traded into. Didn't have to haggle on that either.
They take that away for you? Do they drive off with that?
They do, yeah. When they pick up the car, they drive away with your old car too, which is great. And so for me, the amount of time and the amount of convenience that they brought to me was certainly worth, maybe it was $1,000 I could have saved, who knows? But not having to sit in that dealership, like you said, was really worth it to me. And I would use Carvana again in a heartbeat, and I think that says a lot about any e-commerce model. If you are pleased with the experience, if you're willing to come back, if you're willing to talk about it with other people, says that they've given you an experience above and beyond, I think, what you were expecting.
Let's move on to Zillow. This is a company that Loop is invested in. Zillow, many of you know, is a way to search for homes that are for sale. There's also a rental product. The amount of people that use Zillow, it's US only, it's a high number. In the December quarter, there is over 200 million monthly active users. It is a staggering number. There are approximately 325 million people in the US. Some of those people are not of age to purchase a home, and not that all 200 million are in the market to purchase a home. But when you have that kind of engagement, it really reinforces Zillow's brand. And their products today are essentially, their core revenue generator are advertising products for traditional realtors. And that's not what gets us excited and thinks that Zillow can be a transformative company. Doug, you mentioned complex commerce. I guess it's fitting after talking about Carvana and an expensive purchase. Your home obviously is the most expensive. And ultimately what they're trying to do is leverage the brand that they have around homes and impart the Zestimate and convert that into an iBuying experience. This is a small percentage of homes today are sold and bought online. It's about half a percent. As some context, there's about a typical year, there's about 5.5 million homes sold every year. So that's effectively like 10 million transactions. So it's nascent today. The exciting part is very similar to Carvana, the ability to take something that has historically been a high touch business and convert that to online. The one of the big challenges, of course, is trying to get the price right. And this is similar to the amount of hidden fees. Typically, when people think about selling their home, they think about the 6% realtor commission. But it turns out that there's other fees. We've added them up. It's about 15% of the value of your home when you're selling it. And so there is an opportunity where you can actually sell your home for a similar price as if you're going to go through a realtor. You can do it immediately. You don't have to prep your home. You get cash. You pick your closing date. That's important because it allows you the flexibility to go after a different home, which is particularly important in a competitive market. We announced a couple months ago that we're investors in Zillow. We've heard a lot from the industry about our views that eventually homes can be bought online. And it's pretty consistent feedback that from the industry that we're incorrect, that ultimately is that it's such an emotional decision that we will always have a high human touch. And being a real estate professional is a difficult job. There is a lot of intangibles that are dealt with, and I understand the value that they're bringing today. But despite some of the pushback we've had from the industry, I think it is representative of an industry that's ready to change. And I'm old, I'm 50. When I think about people who are younger, 25 to 35-year-olds, almost 100%, it's something in the low 90% of homes were found online without any broker. This industry is ready to be transformed, and that's why we're big believers in Zillow. We're gonna.
Hey, Gene, can I just add one thought there? A mental model or heuristic we often use is sometimes when experts and people who are involved in industry push back on an innovative product, it's for good reason, and it's a good reason not to invest. Sometimes when they push back, it presents a contrarian opportunity. And if you think about Uber, I think as a great recent example, if you talk to somebody who worked in the taxi industry 10 years ago, they would tell you that's never going to work. The regulation doesn't work. People won't trust other people to pick them up on a street corner. What about a tax, things like that. And of course, Uber has worked very well. If you had listened to people in the automotive industry 15 years ago when Tesla launched a new electric vehicle, after the industry had basically torn apart their existing electric programs, GM had one they canceled in 2001. People in the industry, experts would have said that people don't want electric vehicles. And of course, they would have been wrong too. And so I think it's kind of fun if you're a long-term investor, sometimes really trying to understand why the industry is saying something can't work. If it's their emotion that's speaking, or if there's actually a structural reason, is a really important component to making a long-term investment. When it's just emotion speaking, and we think that's true in the case of Zillow, I think it presents a good opportunity because it may keep some people out of the investment. And then once it starts working and it's obvious, it's undeniable, then people need to come rushing in, understanding that it is the future.
Yeah, we love it when we get this pushback. We take it seriously, and as you said, identify there's more emotion at play, we see that as a contrarian investment opportunity. I would check out, Doug, you want to tell the viewers about your contrarian blog?
I'll give a quick 30-second advertisement. I have a blog, contrarianmindset.com. It is various writings just about contrarian thinking, non-consensus ideas. The reason I started it was Howard Marks, an investor probably many of you are familiar with at Oaktree. I think it was 93, he wrote a memo where he described how the only way to make extraordinary returns in investing is to do something that's non-consensus and right. If you follow the herd and you do the same thing as everybody else, you get the same returns. If you do something different and you're wrong, you get terrible returns. But if you do something different and you're right, you get extraordinary returns. And so this blog is just sort of an exploration into that concept. And this idea of the expert is one thing that I write about there.
Doug Clinton and the contrarian mindset. I'll jump into Jumia, and we're going to just keep an eye on the clock here. Want to run it like a fine timepiece here, but Jumia is e-commerce in Africa. Africa is a big continent. It really focuses on a handful of countries. This is an opportunity very similar to what we saw when we did work on Mercado Libre 10 years ago, the work that we did in China 15 years ago around transformative e-commerce. And Jumia is it's still early. Needless to say, this is a several billion-dollar market cap today. A lot of fluctuations, but we think they're going to be one of the winners in e-commerce. Affirm, moving on, is a company that probably many of you have maybe seen the logo when you're in a checkout, but maybe you don't know much about it. Doug, you want to kind of walk through?
Yeah, they offer a point of sale credit product. So what they're trying to do is basically reinvent the credit card. And when you're about to buy something, for example, a Peloton bike on Peloton's website, you have an option where you can either pay full price for the bike, which I think is about $2,000, or you can pay monthly installments of around $50. And Affirm acts as the lender for that particular transaction. They partner with thousands of retailers right now to offer similar credit products. And it's a very appealing product to millennials who have actually been moving away from traditional credit cards. They use debit cards a little bit more if you look at the data. And I think they're more fond of these things where they know a very specific payment schedule. With Affirm, usually it's set where you have a specific monthly payment over 12 months or maybe 36 months, instead of a credit card where you can have a line open. And so this company is an ex-PayPal mafia founder, just went public earlier this year, and the stocks performed relatively well.
There's been a lot of movement, a lot of conversation around crypto. It is a hedge on inflation. How should we be thinking about crypto?
It's a hedge on inflation. It's also a religion, really. And it's anything like gold, crypto, NFTs, these non-fungible tokens that people are very excited about right now. Digital basketball cards is big. All these things are impossible to value on an intrinsic value basis. So you think about a stock, you would look at a stock on its future potential cash flows, discount those cash flows back to the present, and that gives you a framework for how to think about the value of the asset. Crypto, like gold, has no expected future cash flows. And so what you're really investing in is something that a bunch of other people also happen to believe in right now. And I don't mean that to be a negative take on crypto. It's not at all. Our belief is that right now, Bitcoin in particular is consensus. And as long as Bitcoin is consensus and people want to own it, the price is probably going to keep going up because there's a lot of large holders who are planning on just owning the asset with no plans to sell it. And so you've got this constrained supply. And so long as people want to keep coming in and increasing the demand without a change in supply, I think the price continues to work. But that said, again, I wouldn't put my whole portfolio in crypto like many crypto religious believers do. I think it's something that is worth consideration for the inflation trade. And then after that, you have to kind of reevaluate it as a speculative part of a portfolio, just like gold.
Shifting gears, so one more thought on crypto is if we're going to kind of put it together, Loop's view is that this is something we would have fractional exposure to. We understand the themes that are in play. We wish the currency all the best, but we see for our returns better opportunities here. So want to just talk just the concept of Aptiva autonomous vehicles. This is a pretty hot market. We're going to hold this topic. We think there's going to be one company coming out in the next several months that I think will have a bigger voice in this. So stand by on that front. but the topic around transportation is not fully complete unless we talk about Rivian. This company has obviously done a great job on the larger electric scale. It is fractional. They're just in the early stages of ramping, but has the potential to be kind of one of these brands, the emerging brands. We talked about one of the reasons why we like Ford in the near term, but longer term, we really do see a different class of a different set of players in electric vehicles, Rivian being one of them. Tesla, the numbers that they had for the March quarter, just staggering. We just want to quickly frame in what's going on in electric vehicles, was that the expectations were for, they exceeded the expectations for the March quarter by 15%. And that came with a couple significant headwinds as well. If not for these headwinds, they would have beat the numbers even by more. And as we go and look at Tesla's results for the last 5 quarters, this impacts Rivian too, is we see an acceleration around the beats. This is a definition of a growth story and moving up the S curve, kind of the steeper slope of the S curve. So when we think about Rivian and we think about other electric vehicles, there's something bigger going on. Consumers, the light is slowly going on. There's an infrastructure question around charging. The Biden administration with the transportation or with the infrastructure budget or the plan will likely have increased tax credits for some of these vehicles. So we continue to see some of those. We're going to move on to SpaceX here in the interest of time. Doug, I know you've done a lot of work in space. SpaceX is still a private company, gets a lot of attention. Why should a typical investor care about SpaceX?
I mean, there's probably some sort of a pun about space being literally a frontier, the final frontier, the Star Trek reference. I think that if you think about space, the finding an open-ended market like space, I think, is extremely rare. And if you think about just incredible massive markets over the last 100 years, you can think of the internet, you can think of, the car, right? Like these markets are few and far between. And I think commercializing space travel is probably one of those markets. The ability, and it's not just about, the interplanetary stuff and colonizing Mars. And I mean, that stuff is decades away, probably, no matter what Elon might say. I think realistically, it's probably further away than he might hope. But the ability to do things in space, I think, is going to unlock a lot of industries in unique ways. One potential way is manufacturing in space. When you manufacture things in zero gravity, it actually changes some of the dynamics of what you can do and how you manufacture things. There are companies that are manufacturing very unique products. I've read about a company that's manufacturing artificial hearts. So they have a biological 3D printer that actually prints human hearts. You can't do it in a gravity constrained environment like you could on Earth, but you can do it in space. That sounds really crazy. I mean, you think about futuristic, that's about as futuristic as you can get. But I just think that unlocking space as a mechanism for exploration, for travel, for manufacturing, there's so many things that can come out of it. And SpaceX is the conduit to do that. They are the most efficient way to get to space right now. I think they have a huge lead, and I don't see them losing that lead in the near term.
One piece that I appreciate that we like about the SpaceX opportunity is that they've got a couple real businesses today. They launch, they have customers, governments that they launch different cargo into space. Can be satellites, it can be humans. They also have essentially an internet network. Starlink, yep. And the speeds right now are relatively modest. I think they're like 50 megs down. And to put that in perspective, your basic plan for cable is usually 100 megs down, so it's about half of that speed. And the hope around 5G is to be a gigabyte, so that's about 20x faster than Starlink is now. But undoubtedly, the Starlink speeds will increase over time. Imagine saying goodbye to Verizon and AT&T and your cable company, it would be quite remarkable. Starlink has that potential. And that is what is kind of propelling the valuation of SpaceX. What was the last round at, Doug? 50 billion?
I think it was 65, if I remember correctly.
It goes up fast. And like you said, is that there are a core business, but there's just some marvelous things that they can move beyond space or beyond just the launch business, and think about the manufacturing piece. I've known you for a long time, Doug. I always learn a lot when we catch up in these venues here. As I mentioned, we run it like a fine timepiece, and we are at our time now. And I'll just leave it at that. It's been a joy to be with everyone today. And on behalf of Doug, Gene, and Loop, bye for now. I don't know if I should turn it back to anyone.
Thank you, gentlemen. That was a great presentation. We really appreciate your time. Anytime we get a chance to hear from you, it's appreciated.
Thank you. Bye for now.
Thank you.